Today we're looking at an analysis of the recent 10% drop in Nike stock, which argues this is a huge buying opportunity the market is missing. So let's dive right in.
Let's do it.
Okay, first up, the analysis does a great job identifying the big headwinds that caused the drop, but it really needs to build a stronger bridge between the good news it highlights and how that good news solves for those massive risks.
Yeah, that's the core of it, isn't it? I mean, it lays out the pain perfectly. China sales down almost 17%.
Which is catastrophic.
It's a huge number. And gross margins dropping 300 basis points. You see that and you understand the panic. But then the analysis pivots to North America wholesale being up 20%.
And that's where the connection breaks down. It feels like two separate stories. Here's the bad stuff, and over here, here's some completely unrelated good stuff.
Exactly. It's presented as a distraction from the bad news, not a solution to it. And that leaves this massive gap in the actual turnaround story.
It does. The margin problem and the China problem are sort of left hanging. They're treated as background facts when they are the absolute central plot.
They're the reason the stock crashed. So if you can't show me how the bullish factors, directly fight those fires, the whole long-term thesis feels a bit weak.
So if margin compression is the #1 short-term problem, this analysis needs a dedicated green flag section just for that. A clear path to recovery.
Right. Not just implied, but spelled out.
So let's get specific. That 300 basis point drop. A great improvement would be to break that number down.
I like that. So, for example, you could say, look, maybe 100 basis points of that was from tariffs you can't control. But the other 200 BPS was all due to heavy discounting to clear inventory. Now, that's a key distinction.
Yes, because once you've isolated that discounting piece, you can connect it back to the good news.
Exactly. Now you can build the argument. That huge 20% wholesale growth in North America, that's what soaks up the excess inventory.
And lets them pull back on promotions.
Precisely. So you're not just saying North America is strong. You're saying this strength will directly allow them to reverse, say, 150 basis points of margin compression in the next year. It becomes a concrete forecast.
And you have to apply that same thinking to the China problem. I mean, minus 17% is the kind of number that keeps investors up at night.
It's the headline risk. So the analysis has to say, okay, what's the strategy? Is the argument that North American growth is just so massive it buys them time?
Kind of decoupling from China for a year or two?
Maybe. If so, you have to show the math on that. Or is there a specific plan for China, new products, different logistics, something that will actually stabilize that revenue?
And that plan has to be integrated right into the why we are buying section.
Yes. It shifts the whole thesis from buy the dip to something much more sophisticated. It becomes buy this because domestic strength provides the cover to execute a specific fix for the two biggest problems.
That's a thesis with real analytical depth.
And, thinking about the thesis naturally brings us to the structure of the piece itself.
Right. Our second point. The way the analysis is structured, it sort of blends a short-term trade with a long-term investment, and that creates a bit of a confusing message.
It's a classic trap, right? You see it a lot. The piece jumps between these really high-level fundamental ideas, like the 12 to 24-month outlook, the $85 price target.
A true long-term investment case.
But then it immediately dives into super tactical, technical stuff. The $58 closing price being critical, the risk of a breakdown to $52.
The $50 gap fill trade for a quick 12%. And look, both of those ideas are interesting, but mashing them together, it's not clear who you're talking to.
Exactly. If I'm a long-term investor, I don't really care about the risk of a technical break to $52 next Tuesday. And if I'm a swing trader, I'm definitely not thinking about a 5-year valuation low.
You're blurring the lines, and the risk is that you don't really serve either investor profile well.
The suggestion here is pretty straightforward. It's structural. Just split them up. Create two clear, distinct sections.
One for the trader, one for the investor.
Yes. And since the core of the analysis is about that fundamental strength in North America, that should be the main event. The long-term story gets top billing.
So you could have a section, call it Tactical Opportunity, 0 to 6 months.
Perfect. And in there, you only talk about the chart. The $50 support zone, the double bottom, the $65 gap fill target. And you explicitly state that the stop loss for this trade is a break of $52.
And then a totally separate section, Fundamental Convection, 12 to 24 months.
And in that section, you don't mention the chart at all.
Right. The $85 target here is justified by the fundamentals we talked about, the 20% growth, the margin recovery path we just outlined. You make the case for why the valuation multiple should expand from its 5-year low.
It's so much cleaner. It shows you understand there are different ways to approach this, and you've done the work for both. It's just a much more professional presentation.
It is. It lets the strength of the idea shine through with a really clear strategy. Which, speaking of strength and presentation, brings us to our third point, the tone.
Ah, yes, the tone and style.
Okay, so I want to be clear. I really get what the analysis is going for with its high-energy, contrarian feel. It's effective. It hooks you.
It definitely grabs your attention. No question.
But the use of some of the hype-driven language, I think, occasionally works against the very strong data that's being presented. It can undermine the analytical rigor.
That's a great way to put it. There's this tension. You see phrases like, crashed 10%, all caps, or insane risk to reward.
And the big one, backing up the truck.
Oh man, when I see backing up the truck in a piece of analysis, a part of me just immediately shuts down. It feels like a speculative pitch, not a sober investment case.
Especially when the conclusion admits that the next 3 months will probably be choppy. There's a real disconnect there between the hype and the reality.
So the suggestion isn't to lose the energy. It's to find that energy in the data itself, not in the adjectives. Let the contrast in the numbers create the drama. I love that. Let the facts be the exciting part.
Right.
So instead of a phrase like, everyone is panicking, I see something the market missed, which is, kind of chest thumping,
A little bit.
you could rephrase it to something with more authority. Like, while the market's reaction is focused on these short-term pressures, a deeper look reveals a significant dislocation between the stock price and the company's core operational strengths.
You see, that has the same contrarian feel, but it sounds like a professional analyst, not a YouTuber.
Exactly. Or take the earnings beat. 53 cents versus 37 cents expected. That's a huge beat.
It's massive.
But instead of just saying they were crushing the expectation, frame what that actually means. It implies incredible cost control. That's the real story.
Right. The fact that management is executing so well on the things they can control, even with all these external headwinds, that's the exciting part. That's what a professional investor wants to hear.
That's the analysis. Let the 20% growth figures and that massive EPS beat do the heavy lifting. You don't need to yell. The numbers are already yelling for you.
Well said.